and welcome to another special episode of IPO KYC. Today we get chatting with the management of Atlanta Electricals. This is one of India's leading manufacturers of transformers. Their IPO size is 687 crore rupees, which includes a fresh issue of 400 crore rupees, and the balance is an offer for sale. The market capitalization of the company would stand at about 5,500 to 5,700 crore rupees, as they priced the issue at 718 to 754 rupees per share. So to get chatting about the company, the industry, the plans going forward, we have with us Neeral Patel, the CMD, or Chairman and Managing Director of the company. Neeral, thank you very much for joining in. First, just give us a brief overview about the company.
Thank you. Thank you for calling me. Good afternoon. So just to give you a brief about Atlanta Electricals, we are into transformer manufacturing. Mainly there are three categories of transformers: distribution transformers, power transformers, and extra high voltage transformers. We started with distribution transformers 30 years ago. We phased out distribution transformers completely. Now we are predominantly in the power transformer space. Major customers of our products would be people who are from state for the transmission network on the generation, power generation side, and also to a certain extent power consumption side. So mainly state transmission companies is where we focus on as our customers as of now.
Okay. You've also embarked on a very large capacity expansion. I think your capacity was 16,000, and that's going to go up to 63,000. There is a greenfield plant plus an acquisition. So it's a 4x jump in capacity. Tell us about that.
So fortunately, the company's been doing fantastic. The growth plans of the company are fairly strong. We have been growing since 3-year CAGR was 19%. Our order books are jumping to and showing at 75% growth rate CAGR. So it was our duty to make sure that we have ample capacity to manufacture transformers that are required. Back in FY24 at 25, we were operating at 100% capacity, and the company was hitting a roadblock. That's when we thought about putting up a separate facility, a greenfield project. It is a mammoth-sized, state-of-the-art facility that we've built, which is about 30,000 MVA, and 15,000 comes from the acquisition. Putting all together, it is about 63,000. Yes, it is 4x. Whereas the requirement of the market, we are poised to make sure that the capacities will get utilized to its fullest in the coming years. There's a huge demand of larger transformers, meaning the extra high voltage transformers, and that demand usually comes from the central grid.
So what is the ramp up of the new units going to look like in terms of capacity utilization?
One of the units, we ground broke in April 24. We finished construction by May 25. Just in 1 year, we were able to construct such a large unit. It's already commenced. We've already started utilizing the facility to the extent of over 20%. We see significant jump in the coming half of the year. The acquired facility, we've already started production. These transformers do take time to get manufactured. So we expect by October end or say by November first week, the first batch of transformers will get invoiced. So they are pretty much commenced now.
Okay. When do you think this 63,000 capacity will get fully utilized at 100% capacity utilization? What is the timeline that you have in mind? And what would be the peak revenue at that juncture?
We expect close to about 30 to 40% utilization this year in FY26 itself, close to about 70 to 80% in the next year, and then eventually the 100% by FY28. These utilizations are also going to scale up at stage-wise because we are going to add new technology, newer products also in the pipeline. So it will take time for the first prototype to get made and then eventually taking up the capacity utilizations.
But you're saying 100% capacity utilization of the expanded capacity base, that's 4x by FY28.
Yes.
And at that point, what would the peak revenues look like?
Close to, with the estimates of current market pricing, close to about 3,600 to 3,700 crores.
Okay, so you're currently at about 1,250 crore.
Yes.
And that would go up to 3,700 crore.
Yes.
Got that. You've also changing the mix. So earlier you all were manufacturing 220 kV,
yes,
and now you're moving towards higher voltage, 400, and I think
765.
765.
Yes.
So what will the mix look like now going ahead on the expanded capacity, and how does that change your margins?
Efficient use of the facilities is the key aspect. So close to 40% of the incremental facilities that we've built, we would be allocating for 400 and 765. Balance facilities would still be utilized for 220 kV. Atlanta is one of those companies who has multiple facilities. We have already 2 running in Gujarat, 1 in Bangalore.
No, on a blended basis, for simplicity?
These facilities would be operating at different kV lines.
Okay.
So the incremental kV lines would be close to about 40%.
So incrementally, 40%, I mean, going ahead, FY28, 29 onwards, 40% of your overall capacity would be for higher voltage.
400 and 765 kV products, yes.
And what would that mean for your margins? Your current margins are 15.5%.
That would significantly add to our margins. However, in the current years, we would be actually incurring a lot of costs for technology understanding, the tech tie-ups that we do, technical assistance, and of course for the prototype testing. The prototype testings in these products are also very expensive. So we don't expect significant jump in the current years, but yes, from FY28 onwards, there will be significant correction in the margin profile.
So you've done a very large capacity expansion plus this acquisition. What is the debt on your books?
We're sitting on close to about 340 crores of debt as long-term. Short-term debts are close to about 50%. The 340
50% of?
50% of the 100 crore cash credit limit that we have, so close to about 50 crore. We intend to repay close to about 200 crore of the long-term debt from the IPO raising round and balance to use for working capital.
When do you think you'll be debt-free?
We expect that time to happen by this financial year in itself.
Okay, so you will repay 200 crore right now out of approximately 400 crore, but the balance 200 will also get repaid by the end of this year.
The company is witnessing significant amount of positive cash flows. The market cycle has been significantly improved. So we target for by this year end, possibly the first quarter of next year.
65% of the revenues comes from government contracts. Is there a risk of receivables? Have you all faced cash flow issues?
That's the market perception, but that's not correct. I would say the state transmission companies are also very professionalized now. They have also evolved significantly. They have their systems to keep track of material movements. In last couple of years also, you would witness from my own numbers, the receivable cycles have been significantly improved, and that is because of the professionalizing of the state transmission companies also. The incremental customer that I'll be adding, that is Power Grid Corporation of India to RKT, is also equally professionalized company, and we see good cash flows from PGCIL also.
So you've been growing at 19%, but now you can cater to a much larger demand given your capacity. So what could the revenue growth look like, and what is the industry expected to grow in this period?
Well, certainly we are not intending to cut the growth rate that we are. Say we are at 75% order book growth rate, 19% growth from the existing facilities. Since we already have so much of facilities in place, definitely the growth rates will be much better. Unfortunately, I will not be able to share any future numbers, but we expect an even better growth rate that was shown last year.
Okay, so if I have to summarize, I should say that the company's historical growth rate is 19%. You should do better, going ahead. And the key reason is because you have added a lot of capacity. Capacity goes up 4x, which can be potentially 100% utilized by FY28. The company becomes debt-free by year end, and 40% of your capacity moves towards higher voltage, 765 and 400 kV,
yes,
which is positive, margin accretive.
Yes.
Okay. Just a quick word, one final question on the promoter holding. Even after the offer for sale, the promoter holding still stands at 88%. So why didn't you look at a higher offer for sale and bring it down to 75% and give us a history of the company, because you are not selling. Some erstwhile promoters are selling in this.
Yes, we have Mr. Mehta and Mr. Shah, who are the original founders of the company. They were running the show, and we took over the company in 2007. So they are.
You used to supply to them.
They were our customers, and it was a part of forward integration for us and backward for them. So it was a good synergy between us. 2007 is when we invested in the company, and our intention of doing the fundraising round was to give them a reasonably good exit, which we would be doing through this particular activity. We anticipate significant growth in the business, and we are not as clear as to we would be doing a fresh issue or offer for sale, but there will be certain portions of both coming in future, because the market looks good, and at the growth rate that we are growing, certainly the order books also will get built up.
Neeral, this has been a great conversation. Thank you very much for speaking to CNBC TV18 and IPO KYC. Thank you once again, and wish you all the best.